Bank giants kicking off earnings season. JP Morgan, Wells Fargo beating revenue expectations with help from higher interest rates. But new warnings, though, from bank leaders worrying investors. JP Morgan CEO Jamie Dimon saying that geopolitics and government inaction have led to a, quote, dangerous time, prompting it to prepare for a broad range of outcomes. Wells Fargo CEO Charlie Scharf warning of signs of a slowing economy. So what does all this mean here for investors to discuss this and more? We want to bring in Jones CEO Penny Pennington. Penny, it's great to have you back here on Yahoo Finance. I'm curious to get your perspective. We heard from a number of the leaders of some of the largest U.S. banks this morning, painting a picture of the fact that they're bracing for more of a slowdown. There are some signs that the consumer is deteriorating. What are you seeing in terms of an investment perspective and what your clients are preparing for?
Sure, Sienna, great to be with you and your audience. So Edward Jones, 8 million retail investors across North America. We sit in more living rooms and at kitchen tables and in our branch offices with more North Americans than any other firm working on their long-term strategy. So what the perspective is today is sort of a zoom in and zoom out. Our clients are concerned about, are we higher interest rates for longer? And there's some gives and takes to that in your investment portfolio, some goods and some bads. Should I be investing in equity? Should I stay in cash? We zoom in to talk about that with our clients, but then we zoom back out with them to help them put that into context for what it means for their long-term goals, saving for retirement, putting kids and grandkids through college, leaving a legacy from their portfolio. So just these last 2 days, for example, zoom in and zoom out. There's been lots of uncertainty, things to be concerned about, but keeping our clients focused on the long term is where we are.
Penny, great to have you here with us this morning, and particularly, would love to get your sense of what clients are asking you, your team, especially when we hear comments from the chairman and CEO like Larry Fink over at BlackRock saying that for the first time in nearly 2 decades, clients are earning a real return in cash, can wait for more policy and market certainty before re-risking. And so what is that all clear signal that your advisors would look for that re-risking to initiate?
Oh, so there's a bell that's going to ring? Wow, that would be really wonderful, right?
Outside of the one at 9:30 and 4 p.m., we don't know.
Exactly. So our clients are getting rewarded for risk off right now, for being in cash, for having CDs, for having money market mutual funds and that sort of thing. However, with inflation rates still at 4%, a 5% rate on cash is not going to get you to your goals over the long term. So an appropriate diversification of some cash coming back into fixed income with interest rates probably going to moderate sometime next year. We'll be rewarded for that. And then turning our gaze to sectors in the equity markets that may be away from those magnificent seven that have soaked up all the ink over the past several months. There are opportunities in the marketplace, but diversification is the name of the game.
Penny, where do you stand just on the odds of a recession in terms of some of the indicators or what you're most closely tracking? How much of it is because of potential Fed policy versus some risk that maybe we don't even know about, or maybe one that's not necessarily on our radar yet?
Yeah, well, that risk is the one that is we can't account for, that unknown that might hit at any time. What we do look at is credit quality, pressure on that. We look at consumer spending naturally. We're seeing the consumers spending on services and experiences. They're drawing down their savings rates at this point in order to spend on that, and that continues to be very healthy. But we also know that inflation is being impacted by those expenditures. And if the consumer were to become slightly more reticent in their spending, it would bring down inflation, but obviously have an impact on the economy at large. So it's those gives and takes, those push and pulls that we're looking for. We don't expect a deep recession. We do expect some slowdown, but we don't expect a deep or long-lasting recession.
Penny, I wonder what kind of flow activity you've seen recently. Are there customers who are reticent or who are hesitant to really pile more money into the market right now?
The flows have been into more risk-off kinds of assets, buying CDs, parking money in cash, beginning to look for municipal securities, for example, muni bonds, and the rates on those are attractive in some places. So we are urging our clients to remain focused on the long term and on good diversification. But again, they are being rewarded for fixed income investments where we hadn't been for the past several years.
Penny, when it comes to yields right now, clearly that's one of the topics that's dominating the street, dominating how investors are thinking about future opportunities. When you take a look at the 10-year yield right now, just right around 462, how much higher do you see it edging back towards that 5% level?
Well, this is all eyes on the Fed as well, right? So the Federal Reserve has made it clear that they're going to continue to fight inflation. They are a credible inflation fighter, and with inflation, with that 4.1% that we got yesterday, the Fed has still got some more work to do. Whether that requires another rate increase is left to be seen, because interest rates moving up the way they have is doing some of the work for the Federal Reserve. So we do expect that we are probably at near a peak in the interest rates, and we expect them to begin to moderate next year.
Penny, just quickly, we got to go here, but I almost track AI mentions like days without incident at this point. We got our first one in the earnings season here, and it came from Wells Fargo talking about their AI-powered virtual assistant. What is Edward Jones doing on the AI front, and how do you incorporate that into your model to the point where it either streamlines the customer experience or improves margins?
Right. So artificial intelligence is artificial because it's not human. And so we align it with another form of AI, advised intelligence. So artificial intelligence sits in the background. It helps us be more productive. It does help improve the client and the branch team experience so that we can spend more time in deep discovery with our clients. AI is going to be very helpful. Human financial advisors will not be replaced with AI, but they will be replaced by human financial advisors who are using artificial intelligence appropriately.
All right, Penny Pennington, Edward Jones, CEO, joining us here this morning. Thanks so much for taking some time here with us on Yahoo Finance.